I've spent 50 years on Wall Street and I've never seen anything like this. Goldman Sachs says that AI will create $7 trillion in new wealth, making it more lucrative than the smartphone, the personal computer, and 5G combined. But with all this opportunity comes risk. Just like with the dot-com boom, people will get burned, which is why I'm coming forward today. Today, I want to use my 50-plus years of Wall Street experience to make sure that you're positioned correctly for the AI boom. More than that, I want to show you how to invest in the AI stocks that Wall Street is going all in on, including my #1 personal pick.
It's an economy run by committee.
The banking crisis is far from over.
We're basically sleepwalking into a recession.
The prestige of the U.S. has diminished a lot.
If they destroy the dollar, it's going to actually destroy civilization in the U.S., starting with the people on the bottom of society who they say they want to help most.
Rubenstein's recent comments of the Carlyle Group saying the only way is to inflate your way out of the debt.
Well, no, that is one way. That's a hidden tax, inflation, and extremely dangerous and very destabilizing because people don't like inflation. We've already witnessed this recently. People do not like inflation. So if you run a deficit, there are several ways to handle it. That means if the government's spending more than they're taking in, what are the options? Well, one thing is to have the Fed do what they did when they started running huge deficits in early 2020. And the Fed bought about 90% of the bonds that were being issued by the Treasury to finance the deficit. And when the Fed bought those bonds, of course, that increased the money supply. And the money supply exploded. It actually peaked out in 2021. It was up over 26% on a year-over-year basis. And the rate that it should have been to hit the inflation target of the Fed is something I call Hanke's golden growth rate, and that's about 6%. So it was over, way over the 6% Hanke golden growth rate that would have allowed the Fed to hit its inflation target. So we got a lot of inflation. Now that's a tax. That's kind of a hidden tax. No one votes on it, by the way. It's not a tax that's voted on by the Congress. It's something that's just imposed without in kind of an undemocratic way, shall we say. So that's one way to do it. So Rubenstein, I completely disagree with that analysis from the Carlyle Group. Inflation is a bad deal.
I really want your listeners to think about this is the way that they measure inflation. The CPI, the Consumer Price Index, is a very artificial construct. And in terms of maintaining faith in the U.S. economy, when it suits the big thinkers, they often report the CPI after the so-called volatiles, after food and fuel. Well, that's a fairly silly index for anybody who, like me, enjoys to eat. But a bigger criticism, and I really want your listeners to think about this, is if you are construing the CPI as a cost of living increase, index, please note that the CPI doesn't include tax. As a component of the cost of living for most American families, tax is the largest expense that they face, greater than food, greater than shelter, greater than energy, and greater than transportation combined. A cost of living increase that doesn't take into account the cost of government, the cost of taxation, is, from my point of view, a completely fallacious index. And I think when we're talking to your listeners, Danny, about the potential impact of inflation on them, I think that your listeners need to look at their household budget and understand that the deterioration of the purchasing power of their savings, personally, is much greater than the stated rate of inflation. And what's really important to each individual family is the outcome for each individual family. Measuring the impact of inflation on the purchasing power of their savings is much more important than feeling placated by the sort of bleatings of the political class about inflation through the mainstream media.
Do they want the inflation or not? I mean, it almost seems to me they need the inflation.
At the end of the day, they have to choose it. Listen, there's two huge problems for the United States. One is enormous. You've talked about it for all the years I've known you. It's only gotten worse, and you've had great guests about it. The debt crisis. I mean, it's a crisis. When you see that we were just a few months ago talking about a debt ceiling, and as soon as that was over, we almost added another $1 trillion. It's still hard for me to talk in trillions. When I entered this business 40 years ago, we were the world's largest credited nation. The CBO says we're going to be at $50 trillion in hard debt in less than 10 years. It's the servicing of the interest alone is going to be an extreme big challenge, if not something that can't be done. And we talk as if, there's really no problems long term. We just have to get over whatever little humps are in the road. And that's not the case. And so when you add that to a retirement crisis, I just say that, these things are just huge challenging. And the easier way always for a politician and is inflation versus deflation. Deflation is horrible. We saw that in the Depression. No one wants to go through that again. So they will choose inflation over deflation, no matter what they may say politically at the moment.
The biggest asset in America today is student loan debt. In other words, America is getting rich, and thanks to Barack Obama from Hawaii, Barack Obama basically let student loan debt loose, and now is our biggest asset of America. In other words, America is trying to survive on the backs of our college kids. If that's not criminal, I don't know what is. It just feels unconscionable to me. That's what I'm saying.
And Biden forgiving $39 billion of the debt.
Yeah, but that's a drop in the bucket. You know what I mean? It's. I think our student loan debt is $1.6 trillion.
Your take on their fight against inflation here, because there's a new study out that 61% of Americans say they are still living paycheck to paycheck, even as this inflation supposedly cools.
So inflation is cooling. We're predicting deflation at the beginning of next year at Finance Technologies. We think the Fed is engaged in a major policy error. We saw bank failures earlier this year. We think more are coming. I think what the Fed is missing is they're looking at the employment rate, and the employment rate remains low. I've been of the opinion that there's an issue with vaccines that's caused major disability issues that has reduced the labor pool, making the unemployment rate look lower than it is. Now, what's interesting is Luke Grahman, an economist, has come out and said basically the same thing. He didn't name the vaccines, but he said something's going on with the increase in disability that maybe is affecting the employment numbers. So the Fed is maybe looking at a number that isn't reflective of the true tight labor market, and they're gonna crush the economy. The economy's already going to get crushed. It's a question of how bad, and the longer they keep rates up here and or incrementally raised, the bigger the disaster is going to be.
Thoughts on the Fed and their game plan right now?
Look, the Fed's going to go as high and as long as it can before it creates a panic, okay? And the game plan right now is to suck as much money out of the system as it can without causing a big earthquake in the system. And you're seeing this all over the place. You're seeing it in real estate. You're seeing it in private equity. You're seeing it in corporate financing. You're seeing it in individuals don't understand what's happening, but they're spending down their savings. They're living a lifestyle they can't really afford, and they're yet to adjust to the new cost of money. And so the Fed's going to be able to keep this up for a little bit longer. And I don't think the Fed has a plan. I don't think they ever have a plan. I think they had to kick this off because there was too much money in the system after the COVID, all the COVID financing that they did.
The Fed was created in 1913, and it shouldn't have been created. It was unnecessary to have been created. But when it was created, the basic idea was to act as a clearinghouse for banks in the U.S. to adjust them over temporary bumps in the road where mistakes are made. But since then, it's risen to the point where it controls everything that happens in the U.S. The U.S. government is running trillion-dollar-plus deficits every year. The Chinese aren't buying that extra debt. Japanese, nobody's buying it. The Federal Reserve is buying all that debt that the U.S. government is issuing and floating the money into society at large, debasing the currency. So, look, the Fed should be abolished. It shouldn't be reformed. It should be abolished, quite frankly. And fractional reserve banking would be abolished with it.
I mean, would you still argue that the US dollar's best days are behind it? Because there's all these announcements, like this one right here, India signing an agreement with the UAE that would allow it to settle trade in rupees instead of dollars, boosting India's efforts to cut transaction costs by eliminating dollar conversion. So all these countries kind of trying to leave the stranglehold of the US dollar, rebelling against the US dollar. I mean, at some point it has to add up to something significant.
Oh, 100%. The days of the dollar being the world reserve currency are fast coming to a close. And that move actually didn't start even, and it started back in 2002, because that was when the Federal Reserve first had to buy US debt, which is an indication that the world was either saturated in it or they weren't able or wanting is probably a better word, to buy enough of the U.S. debt that we were trying to shove down everybody's throats. So yeah, there is absolutely zero doubt in my mind that the U.S. dollar is losing its position as the world reserve currency.
More and more countries are just settling between themselves and their own currencies. And that trend will continue. I mean, the dollar index right now is around 100. It was like 105 just back in March. So it's losing value on the Dixie, the dollar index, pretty rapidly. And I think the next threshold, I don't have all my charts in front of me, I think it's 92. And then if it breaches 92, then it's 70. And once it gets down to that level, and I think it will, there'll be more and more of a rush to settle outside of the U.S. dollar, settle in precious metals, settle in crypto, or what have you. So the dollar's days are numbered.
Yellen has been vocal about the fact that the U.S. dollar as a reserve currency, its status is being chipped away. I thought that was interesting. So they're obviously paying attention. But how concerned do you think they are?
I think that if they're not concerned, they should be. De Gaulle described the United States' possession, if you will, of the reserve currency status as exorbitant privilege. It is precisely the fact that ours is the deepest, most liquid, most transparent financial market in the world that allows us to do the quantitative easing, which is to say the counterfeiting that we have done. We export our deficit to other countries as a sort of a fee that we get, we being Americans, get for maintaining the world's reserve currency. I need to say that the enemy of our status as a reserve currency is not cited in Moscow or Beijing or Buenos Aires or Rio, or Sao Paulo. It's cited in the United States.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.